As expected, the U.S. Federal Reserve lowered its key rate by a quarter point to range between 3.5% to 3.75%. Joining me now to discuss is Scott Colbourne with TD Asset Management. And Scott, did anything stand out for you today?
Well, there was a couple things that stood out to me. The Fed did cut rates 25 basis points, as everybody expected. But I would say there's a handful of things that really stood out. One is dissents. That hasn't happened in a long time. Going into this, there was a consideration of as many as 5 dissents. We got 3, 1 for 50 basis points of easing and 2 for basically the Fed on hold. So that is unusual and speaks to the tensions in terms of the dual mandate at the Fed. The second thing was a surprise announcement on balance sheet reserve management, and they call it reserve management policy. Unexpected, sort of the Fed had hinted that we were going to move towards the Fed, had ended quantitative tightening December 1st. Now there was a question of when, they might start purchasing short-term instruments and add to reserves, and that came today sooner than the market had expected. So, there was that, and then obviously the Fed introduced this language called, extent and timing of further adjustments is basically dependent on the data, and that, there's a big when are we going to get a lot of the data is an important part of the the direction of where the Fed goes after this, what I would characterize as the last of 3 risk management cuts that Governor Powell had sort of acknowledged that the labor market was weakening. They did these 3 cuts. Now we're going to sit back and we're going to have to deal with a divided Fed, and see where we go from here.
And that's my question, because we have seen a lack of data. So what are the chances of a further cut next year, especially if we do see that inflation remains sticky and that data is just not there?
Yeah, I mean, we could be having this conversation next week because we're going to get 2 labor market data points next week and then another one by the time the Fed meets in January. And all of what we're talking about right now, including the SEP, and all their forecasts could change dramatically because of their emphasis on risk management towards the labor market. So that in mind, at the moment, the SEP forecasts give us a sense that, basically there's 1 cut priced in for next year and then the year after as we get close to the terminal. So the leaning is that the Fed wants to continue its path towards neutral, which is ultimately 3%, and another cut each in the next 2 years. At the margin, the markets are taking this as the combination of the reserve management policy and the cut and the slightly less feared dissent profile. It can be interpreted today as less hawkish than expectations were going into the meeting.
And what are U.S. bond yields telling us about the Fed's next move? Because we see a lot of uncertainty around a change of leadership at the Fed that's going to happen next year. We've also got the Supreme Court's looming decision on tariffs. What is the bond market telling us right now?
Yeah, I mean, we've had a inflation market, the inflation tips market, giving it basically a steady range on the inflation expectations. We've had a slight pricing in of slightly higher term premium in the longer end of the market. But basically, for the last little bit, markets have been in a bit of a range with a slight upper bias. The extent of the curve steepening that was a big theme this year in 2025 has sort of abated in the last couple months. So, basically, I think the markets are fairly priced for where we're going right now, but, we're going to have a deluge of data. And as you acknowledged, there is going to be a big shift in the Fed. Obviously, Governor Powell's term is up. His last meeting's in April. We'll have a new governor, and we have the Lisa Cook potentially maybe off the Fed governor board of governors. So we've got lots of cross currents at play that could change dramatically in the first quarter of this year. But for the moment, this sort of steadiness with a slight curve steepening bias.
Okay, so given that outlook and this latest decision, what's your outlook on the U.S. dollar going forward?
So I think, when we look at what was supportive of the U.S. dollar, it was this sort of exceptionalism, starting with, monetary policy was exceptional, an incredible fiscal tailwind, and then we've had the exceptional equity market and AI. monetary policy is less exceptionally globally now, right? We've actually seen in the recent weeks a shift in Reserve Bank of Australia, New Zealand, and even here at home, where the bond markets have started pricing out any further cuts, and in fact started to look. So the U.S. dollar is less exceptional, and so one of the markets that have moved after today's meeting a little bit more is the U.S. dollar is a little bit weaker, and I think that's a trend that we'll continue to see play out next year.
And finally, I want to talk about some of the things that you'll be watching closely over the next few weeks, most likely weeks, that could sway the Fed, towards potential cuts in 2026.
Yeah, I'll start with, as I mentioned earlier, I'm starting next week with two labor force drops, and then another one in January. That will set the tone, in terms of where we're going in the labor market. Obviously, there is Supreme Court rulings, IEPA, Lisa Cook. Those are all very important for the composition and extent of a Fed that is divided, right? I mean, we look at today's SEP, and there was actually 6 dissents, what we call soft dissents. 6 governors didn't want to cut. We only had 3 that were in the minutes and acknowledged. So there's a Fed divided. There's lots of tensions, lots of different outlooks. The Governor Powell acknowledged that today. He said, look, there's a tension between inflation and labor market. And so that is what we're going to have to resolve. And we're going to start with 3 very important data points into January's Fed meeting.